The Rebel Capitalist Show.
With the average person, how do you suggest they try to navigate these types of waters? Prices are at all-time highs, adjusted for inflation and in nominal terms in many of these markets. And then they're COVID-19, then there's stimulus, interest rates being at 5,000-year lows. And, how much longer can that last? And all these things are going through their minds. If they're just, maybe they're not interested in real estate investing, but they're just trying to make the best financial decision for themselves, whether to sell their current home, take out their equity, and maybe buy something that's a little cheaper or maybe in another area. Or maybe they're just considering that first home purchase or buying a new home. What do you tell those people?
Well, let's face it, there's a lot of those people, George.
Yeah.
Most people are never going to invest in real estate. The average person in the U.S. owns less than 1 ounce of precious metals, which means most people don't own any, because there's lots of us that have lots more. So to talk to the person that is average and ordinary, there's really two things, I think. There's education, which you got to be careful about. When the student is ready, the teacher appears. If the teacher just appears and starts lecturing, it's not going to work. So there's education, and then there's the understanding of that. So they have to make decisions based on what their plan is for their life. If they expect to be in the same city for the rest of their life, that's different consideration than if they expect to move out to another place when the kids grow up, or whatever their situation is, when they have another child, etc. So I was just today talking back and forth with a realtor friend who's in a really high heated market in California. So it's multiple offers, everything's selling for 5 or 10% above asking, and his clients are exacerbated. And they're like, maybe we'll just sit it out and wait. Well, you can always sit it out and wait, provided the assumption that sometime the prices are going to come down is true. And that's likely to be true because we follow real estate cycles, and what goes up comes down, but it doesn't always come down when you want it to. And just looking at this last year, these folks have been looking for a house, made several offers and gotten beaten out every time. And they're just wanting to put the brakes on it because they're frustrated. And so I just did some math for them, said that you're looking at an average, $500,000 home, which is not much in Northern California, but if that were the price, and you've seen 10% appreciation, or I think 8% appreciation is what I told them, that would be $40,000 on a $500,000 home in a year. They've already spent a year. They've lost $3,300 a month while they've waited. So had they have paid even $12,000 more a year ago, how would it look? Now that's easy in hindsight. But here's a really important thing. The price of your house only matters 3 times: when you buy it, when you sell it, and when you refinance it. Other than that, the home you live in, it doesn't matter what it's worth. If you can afford and you're eligible for the payment, whether, you're, in this case, if you're buying, you can qualify for the mortgage, and your lifestyle can accommodate that mortgage payment, you've got a place to live. So here's one of the big challenges in real estate. We blur the line when we talk about a home. People buy a home. My sister just sold a home she lived in for 25 years and made $1 million. It's probably the only time in her life she's going to make $1 million. And guess what? She got up and went to work every day, built a great business, which she sold for a few $100,000. Meanwhile, her home sat there and made her a millionaire. So if all you have is your home, we're blurring the line because you live in that and you interact with it. Completely different mentality than an investor who approaches any investment differently than they do the home they live in. So in terms of how you speak to these people, this is one of those things. Understanding, first of all, who are they? What do they want? And then what's the likelihood to happen in their market and in the macro picture?
Yeah, and see, the problem that I see is the Fed has turned everyone into a real estate investor. Whether they like it or not, they have to be, because they're trying to hit this 2% inflation target. So you can't just put your money in the bank, because you're going to lose purchasing power to inflation. You guys know how that works. So we've forced the average Joe and Jane, just like your sister, in a way, to become a real estate speculator, or maybe a stock market speculator with their 401k, because that's going to be between their 401k and their house equity. For most people, it's going to be 100% of their net worth when they retire. Russell, one thing I wanted to ask you, when you're going through these numbers, how do you think about prices, nominal prices versus real prices adjusted for inflation? Because we're talking about how real estate prices usually go up. That's very true in nominal terms. But if you look at home prices adjusted for inflation, as an example, between 1900 and 1998, they were pretty darn flat because, to Robert's earlier point, they pretty much go up with the rate of inflation or with wages. Do you specifically focus on nominal prices because your debt is, you're using fixed rate debt, or how do you guys think through that?
For most people, I agree with Robert. The first place to start is you have to be educated. I don't care. I understand that Wall Street likes to put little babies in cribs and high chairs with a trading app to show how anybody could do it, and they clearly know who the avatar is. But if you want to take advantage of all of the benefits that real estate can provide, which is double-digit annualized returns with very conservative positions, everything from a portfolio management, diversification, financial planning thing that you can do with paper assets, you can do with real assets, and you can actually do a lot more. And the secret to making real estate really work is debt. And the fact that the Fed is committed to creating inflation is great. The fact that they're committed to creating mortgage-backed securities as part of the financial system is great, because that means that they're going to pump a lot of money into real estate. And even if they accidentally overstep or they set off a bomb like they did in 2008, they're going to fire up the printing presses, put the air pump back on the jump house and get it back as quickly as they can. And if you understand that, then you don't look at those as crises, you look at those as opportunities. And, we're all hoping that that's about to happen. Now, we don't think that it's going to be as bad as 2008. I don't, only because I think that the Fed got the lesson the last time. They figured it out. It was devastating to, what happened in the country. So coming back to, looking at the math, the first thing is you have to understand the concept of arbitrage. And arbitrage is borrowing at one rate and earning at another rate. And that is how you acquire debt without going into debt, right? If you have to make the payments off the sweat of your back, you're in debt. But if you use your debt to acquire assets that pay for themselves and make you a profit, technically you're in debt, but really you're not, right? Because your balance sheet is not going to show that you're in debt, because you're going to have positive equity. And if you do, as I said, and look at your net worth based on the production of income, passive income at some capitalization rate, then you're going to actually be creating real net worth with all of the collection of the passive income. For the person who doesn't want to get their hands dirty, because real estate is a messy business, and everybody listening to this should be thanking God that it is, because if it was a commodity, you couldn't get a deal. If every 3-bedroom, 2-bath house in America sold for the exact same price, the way a 1-ounce gold coin does, right, how do you get a deal? You can't get a deal. But because every single ownership is different, every single neighborhood, the condition of every single house, motivation of the seller, your credit, on and on and on, it's very, very possible in any market to go out and find a relative bargain. And when you find something where the numbers pencil based on your credit, your resources, the rent, the neighborhood, all of those things, and you feel that you can gain control of a property where those macro factors we talk about are there, and to Robert's point, you're not buying it to sell it next week. You don't care what the price is in 2 years. I care where it's going to be 10, 20, 30 years down the road. I'm building a portfolio. Now, that doesn't mean I'm landlocked with my equity. Far from it. You asked earlier, what are we talking to people? Right now, my favorite strategy for people that are sitting on what I consider to be a lot of equity created by artificially low interest rates, I say, get it out of your property. Well, I don't want to sell my property. Then don't. Keep the property, use your great credit to go get a 3% mortgage, pull a couple $100,000 out of the property. Now you've separated the equity from the property, but still get the upside of the property, still get the benefit of the property. And now, oh yes, you have a 3% on 200,000. So you got to pay $6,000 a year, $500 a month, which is tax deductible, by the way, if you use it for investment purposes. So your net is even lower than that. It's not free, but it's pretty darn close. But still, who wants to make that payment? I don't. So now I go out and I make a private mortgage, maybe a couple of them for $50,000 each at say 6% or 8%. Now let's call it 6%. So now I've got all the money I need coming in on half the proceeds to pay for 100% of the proceeds of the loan, right? Because I've got 6,000 coming in on 100 and I got 100,000 free and clear. I say, well, I don't think it's a good time to buy. No pressure. I don't have to. I can sit on the cash and wait for the market to retreat. Or I can say, hey, I don't have faith that these dollars are very safe. We're going to lose purchasing power. The Fed's printing. Great. Buy precious metals. Stick it in the safe. Now you've converted equity on your real estate equity into precious metal equity, but it's still equity on your balance sheet. Nothing's changed. You've improved or kept your cash flow neutral. And oh, by the way, if you get into financial trouble on your residence where you have the mortgage, hand them the keys because you already took the equity.
I love that first point you made about becoming maybe a hard money lender, in the sense that you can take that equity out. Now you've got positive cash flow after someone else makes your mortgage payment, and you've capped your downside. And
yeah, so like a reverse mortgage is, you see a lot of ads for reverse mortgages, people trying to create cash flow off of their equity, but they're doing it all wrong. You don't do it by taking out a loan. You do it by arbitrage. Take a loan, make a loan, and make money on the spread.